Good day guys, in this video I'll be explaining the basic foundations of ICT concept and the basic foundation of market analysis in generally as a whole. Showing us from this particular schematic drawing I have to actually be able to read the market from the very basic understanding of the market. Now before I go into this specific diagram I have here, I would love to show us the basic candlestick representation here. You can clearly see the fact that for every chart we open, we actually find a series of candles that actually follow each other. Now these candles actually have a meaning. They have what they mean. The candles that we clearly have, they have actually price representation over a period of time. And this price representation over a period of time is actually represented by a candle, as you can see. And for each candle actually has what we refer to as the opening price. So where the price opens for the day. Now, depending on the time frame you're actually on. So we actually have different time frames. You have 1 minute time frame, you can have 15 minutes time frame. So depending on the time frame you are on, so you have the open for that time frame. Let's say for example the daily time frame, you have the open for the day. When the price opened the day to be this area here, the beginning of the body of this candle. Then when the lowest point price moved to in the day, so and then you have the highest point price reached in a day, and then the close of the day where price closed for the day. So this is actually a bullish candle, but in a bearish candle, you actually have when the price opened for the day, where the highest point price reached for the day, the lowest point price reached for the day, and where it closed. Now, if this was a 15 minutes candle, it's still the same thing. The opening price for that specific um for that specific 15 minutes interval of the time frame of a time. So let's say for example you are actually at 1 o'clock. So when 1 o'clock started, that means that from 1 o'clock to 1:15 to be represented by what one candle. And when the price opened at 1 o'clock, to open at what this body, the beginning of this body here, then the lowest point price reached for that candle, the highest point price reached for that candle, and then when the candle finally now closed at 1:15. So we have different representing using candles representing different time frames also. That's what we have. So you have the bullish scenario, this is a bullish scenario, and this is a bearish scenario. Now quickly moving from that, now let's go back to our chart. So you will now have that series of candles, now following each other like that. So when from 1:15, then from 1:15 to 1:30, so depending on the time frame that you are actually on. But now looking at the schematic is just like the a overview of the whole chart itself. So how do you now read the basic market structure? Because that's what I want to explain now, the market structure. So how can you read the basic market structure in a particular chart? Now looking at this example here, you can see clearly the fact that, let's say for example, we have a series of candles following each other like this. So this is what we call an impulsive move. So let's say for example, you have an impulsive move like this, then you have an impulsive move, a series of bullish candles going up, a series of bullish candles, the one actually the green one, a series of bullish candles. So clearly it might, the green is just for you to identify that this is a bullish candle. So it's a series of bullish candles going up like this. Then you have a corrective move. This is which we refer to as a pullback, which will be a series of bearish candles. So in the bullish and the bearish scenario of the corrective and the impulsive move, they can actually be what's it called, bearish candles in the bullish scenario here. They can be bullish candles here, but the major candles that are here are what are bearish candles. The major candles that are here are bullish candles. So that's just what a impulsive move and a corrective move. Now when we now have impulsive move and a corrective move such as this, we have what we call swing points. Swing points are those areas where price reverses. Swing points are those areas where the price reverses. For example, when the impulsive move is coming to get to a point and then to start reversing. So at that point when you start reversing is what we can call a swing point. So any chart, you can actually identify different swing points. You can identify what swing highs and swing lows. Swing highs and swing lows. So Swing highs and swing lows simply means the fact that swing highs are actually what the highest point price reached. Swing lows are the lowest point price reached. So for example, these are swing highs, swing highs, swing highs, swing highs, swing highs. Yeah, these are swing lows, swing lows, swing lows. Now in ICT, there's something called break of structure, BOS, break of structure. So break of structure simply means the fact that a swing low simply breaks above a string high. That's what it means. So for example, in this particular case now, you can see that this swing high here was broken, right? Price broke from this swing low and broke above this former swing high. This new swing high, price from this swing low broke above what this former swing high. Now, looking at these now, a break of structure what is now what established. Meaning the fact that when price was able to break the former swing high, that's what we refer to as the break of what? Of structure. Now, these swing highs and swing lows are referred to in another sense. For example, the word swing high and swing low is actually generic. For example, in this particular, this is what we refer to as an uptrend, where we have series of what? Series of higher highs, series of higher highs like that, series of swing highs being broken. That's when you have an uptrend, which we have in this case scenario like this. You can see that you have a series of what swing highs, what's being broken up and like that, and then price is what's going up. The swing lows are not broken, but in a downtrend scenario, this is an uptrend. In a downtrend scenario, we have what we refer to as we have where we can now see the fact that swing lows are what are being broken. So swing lows are broken down, broken down, broken down. The swing guys are not broken. So it's just like that shows you the momentum of the market. That shows you the people who are actually what in control of the market. In this particular case scenario of uptrend, we have buyers in control. Meaning that buyers are able to push the price above the former what swing guys. Buyers are able to push the price above the former swing guys, above the former swing guys. That's what we have in that case scenario. Now, that being established, we now have what we refer to as higher highs and higher lows. We have what we refer to as lower highs and lower lows. So this HHR rate is actually is what I refer to as higher high. This is higher low. This is lower high. This is lower low. Now the swing high and the swing lows are what are generic names. Like they're actually common to both uptrend and what downtrend. But higher highs and higher lows are only specific for an uptrend. Lower lows and lower lows and lower highs are what are specific to a downtrend scenario. Now, in the uptrend scenario as we have here, you can see that price continuously breaks above what the former swing high, right? So we now establish that these swing highs here are what are called higher highs. These swing lows here are called what higher lows. When price then breaks above again, this is what and our new what higher high is our new higher high. Is our new higher high. Is our new higher low. So here we have a new a new higher low here. Higher low, then higher low, higher high, higher low, higher high. So this is our new higher high there again. Yeah. Then when price broke below this our higher low here, you can clearly see the fact that sellers have now been able to what finally established what a breaking point here. So they were able to break below this higher low we have here. So them being able to do that shows the fact that what the character of the market has shifted. The character of the market what has shifted. And in a case scenario like this, that's what we now call change of character what is now established. Change of character. So don't forget the character of the market initially was fact that market was what was bullish. And then we have series of what of break of structures. We have a series of break of structures to the upside. You have a series of break of structures to the upside, series of break of structures to the upside. Yeah. But when the character of the market shifts, when a higher high breaks below what a higher low, then we have a change of what of character. So when we have a change of character too, then when the higher now the lower highs now breaks below the lower lows. In the case of what of a downtrend, then we now have what we now also we will still refer to that as what as break of structures. So now the break of structures are what to the downside. Break of structures are what to the downside. And we also if we have another what when the lower high is what is broken above from what the lowest low here. So we'll clearly have what change of character again. Where we have a change of character here again. So we have a change of character here then break of structures again to the upside, break of structures here to the upside. So that is what market structure basically is. When you have higher highs being broken, then you have break of structures to the upside. When you have a higher lows what being broken to the downside, that's a change of character. When you have lower highs being broken above, that's when you have a change of character, such as this. So this is what the market structure basically what is in ICT. And when this is well understood, clearly you'll be able to to be able to read any chart. Now, let me just quickly show us an example of this in a live chart. So in this particular live chart here now, you can clearly see the fact that we are in the 4 hours time frame. I want to go up to the daily time frame. So if you were to look at the daily time frame, you can also read that even here. Can you see that we have break of structures at these areas? There's a break of structure here. There's a break of structure. 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 There's also a break of structure. You can clearly see at this point here we had a change of character. And when the character of the market shifted, what happened? You can see that price began to move up. So the sellers were in control all the way down to this level. Then the buyers took control of the market. Now, for let me just say one last thing before I end this video. Now, you can clearly see the fact that for you to be able to establish a valid pullback, at least it must be three candles consecutively closing above each other in the case of a downtrend. Look at this. You see that for this to consider this as a valid pullback, because it's not everything you can call this. I can't consider this as a valid pullback here. This is not a valid pullback, so I can't consider this as a break of structure because this is just a still this going up. You understand? Then this is now the pullback then to the side, but I can't consider that. You understand? The reason is just because the candles are not up to three. So three consecutive candles must close above each other for you to be able to establish a valid pullback. Then that now leads to break of structure. So this well understood, you know, gives you insight to what the market intends to do in the future, or what the market has been doing in the past, and what the market intends to do in the future. Where the price is how the price has been moving over a period of time, and how the price intends to move for the next period of time. So that's what market structure helps you to be able to see. Now, this schematic, if well understood, you can actually be able to analyze any market. You can be able to analyze any market. So let me just leave you with this. I will come back in another video and I will explain to you um the next step from understanding the market structure, the next required things for you to actually to understand. Thank you so much for watching. I would love you to help me smash the subscribe button, help me smash the like button, and leave a comment below. Comment your view about what I've actually explained. If it was quite explanatory or not, let me hear your view. Thank you guys for watching.